Toronto's pre-construction condo market has collapsed. Recent reports show extremely low sales. In Toronto proper, only 53 new condos sold in September and only 54 sold in Toronto in the month of October, compared to hundreds selling in those months in 2024. That 1 month drop in the 60 to 70% year over year range is the worst that we've seen in decades. And it's worth noting that even 2024 was a horrible year for pre-construction condo sales. We're down almost 20% from last year across the GTA and 90% below the 10-year average. In October 2025, only 570 new homes sold, down 29% from October 2024 and a staggering 81% below the 10-year norm. This is now the 13th straight month of record low new home sales in the region. Now, for yearly totals, looking at 2024, the Greater Toronto and Hamilton area saw only 4,600 new condo sales, which was 64% below 2023 at almost 13,000, giving us the weakest year since 1996 in 2024. But we still weren't weaker than the 1990s in 2024. 2025 looks like it's trying pretty hard to beat that record. In 2025, the trend continued down. Industry data shows that condo purchases and pre-sales are off by roughly 50 to 65% year over year. In short, sales are at historic lows across Toronto and the GTA, and these declines mean far fewer units under construction. New condo starts have slumped as well. So the entire housing pipeline is thinning because in the Greater Toronto area, we use the pre-construction model to get a lot of our apartment housing stock built. It allows developers to take less risk because they have purchasers who are going to take possession of those units on the tail end of the project, which means that the revenue is locked in. This is different than a lot of the purpose-built rental housing that we're seeing being built across Canada, which is ramping up, but that doesn't work well in Ontario and especially in the Greater Toronto and Hamilton area where rents are really low relative to household incomes. And this means that it's very hard to deliver affordable housing with the current build costs that developers have to deal with to get housing to market. We are seeing a lot of these projects pivot into purpose-built rental, which is a trend that I predicted a couple of years ago, much to the dismay of a lot of builders who, when I made that prediction, told me to F off, basically. And for the ones who can't afford to pivot projects and make projects work as rentals, they're doing it because it's the only way to keep the machine moving. And this is really where you start to see the big impact. There are two major impacts I want to talk about today. So number one is that this sales drought is already straining the construction industry, and analysts are warning of massive job and project losses if this continues. Altus Group estimates that if sales stay depressed, Toronto's housing construction sector could lose up to 41,000 jobs, direct and spin-off. In fact, construction employment has already slid. By May 2025, Toronto construction jobs were at their lowest since early 2021, when we were in the midst of a pandemic, down about 35,000 from late 2023 levels. Ontario's construction unemployment rate is over 10% now. In short, the housing construction engine is stopping, and Altus says that it could lose nearly half of its jobs in home building. With pre-sale demand gone, many planned condo projects are being paused or shelved where they can't be pivoted to purpose-built rental. CMHC noted that Toronto condo starts fell 60% in the first half of 2025, which is the lowest per capita level since 1996. 1996 is a significant number because that was the last time that we saw a housing countercycle take place and the bottom of a housing market happen. And CMHC explicitly links the drop in investor demand to cancellations, delays, and a sharp drop in construction. Basically, these projects stop being a quick buck, speculative, exciting casino for investors, and now the music stopped. We're going through that swimming naked moment. Numerous high-profile projects have been delayed or put on hold for builders as they struggle to meet financing thresholds. For example, multiple sources report dozens of condo projects totaling thousands of units have been canceled, converted to rentals, or paused in 2024 and 2025. And this is because builders have to hit a pre-construction sales threshold of about 70%. So they need to pre-sell in the pre-construction format 70% of the units for a lender to feel confident enough that the project is going to succeed to give them construction financing for that project. And even projects that are dropping their prices substantially. Like we've seen a couple of projects drop into the $800 per square foot range on a pre-construction sale. Even those projects aren't able to hit their 70% pre-construction sales threshold. So the pipeline of new builds is shrinking, and Urbanation reports 2024 condo starts fell 51% from 2023, the lowest annual level since 2002 when we were in the blow off of the dot-com bubble. And Bridge Broker Analysis and CMHC both warned that the slump in pre-sales means many planned starts will simply never begin, leading to a long-term shortage of supply once we get past this cycle and all of that existing inventory gets absorbed. Does that necessarily mean that there's going to be like a bull run or some huge issue with affordability in the future? Affordability, maybe, but I think a lot of that's just because relative to wages, house prices in the GTA are horrible. But is it going to cause a bull run or like a huge run up in prices when we get to the recovery phase of this? I don't know. I don't necessarily think so. And I'll explain why with some new economic analysis towards the end of this episode, which talks about how delivering more supply will actually have a cooling effect and an affordability creating effect on the remainder of the market. And right now we are seeing this huge flood of supply. We desperately need to figure out a way to backfill the gap that's forming with purpose-built rental, which I'm starting to see happening now, to be honest. And I think if your rents respond by pushing up first, then more rental developers will enter the space. A lot of these condo projects are just going to have to shift into that space. And I think a lot of that will get backfilled by rental, which is why my thesis has always been that Canada is just going to be basically speed running towards a renter's economy like we see in Europe. So all in all, builders are facing a freezing market. And without a quick rebound in sales, construction will slow dramatically, costing thousands of jobs and leaving many projects stalled. And this ripples through the real estate market. It's shaking investor and developer behavior across the market. Condo investors, RBC Economics notes that investor appetite has traditionally fueled Toronto's pre-construction market, and that's appetite has largely evaporated as higher rates and weaker rents have eroded expected returns. Many of the speculators have moved back to the sidelines, and instead buyers increasingly favor either existing resales because the economics of resale was always better, or a lot of that investor speculator demand is actually shifting towards these purpose-built rental projects in markets like Alberta, especially. Do I think that there's another, potential moment happening for those individuals? Probably, given Alberta vacancy rates have jumped from like 2 to 7% or expected to go even further than that. But that's where a lot of that investor demand is shifting. And that investor capital is shifting into like multiplex projects and CMHC MLI select projects outside of the province of Ontario because they don't work super well in the province of Ontario. So pre-construction condos are off of investors' shopping lists for now. And probably for a while, because it takes so long to come back from this like huge loss like this. Like how much is it going to take for people to have this confidence? They're, like in the 1990s, when everybody was paper flipping contracts on single family detached houses, there's the same thing happened, right? It was more detached. Look at how many like baby boomers won't touch real estate as an investment grade asset class. They'll do it in their primary residence, but there's this whole generational like shift in, okay, we learned our lesson. We all got burned. We're never going to touch that asset class again. That to me is what the condo sector is going through now. And I think you are going to see like, look at what happened with the last cycle. It's going to take 10, 20 years for confidence to get back to what it was. Like, it's not like it's just going to bounce back. Altus also, or Urbanation also observes that it's huge glut of unsold units piling up. Nearly 25,000 new condos were unsold at the end of 2024, which is a record high, although not as bad as the 1990s, which I have done relative to total supply. So, I covered this in a video that I did about the chart book from Oxford Economics. Now, this is at a national level, but you can see that there's in the 1990s, the amount of unsold or unabsorbed units was much higher than it is today. And RBC also highlights that unsold units under construction hit a 9-year high in 2025. So the oversupply is giving buyers leverage. Many buyers are patiently shopping the resale and even pre-construction markets, especially first-time buyers who are now getting this HST benefit, knowing that new project prices are still elevated and there should be room for builders and sellers to start dropping prices, right? As it stood, everybody's been doing everything they can to try and not drop prices, but now they're all sort of having that come to Jesus moment where they're like, we don't really have a choice, right? I think a lot of people held out and said, oh, eventually it's going to get better. And now they're realizing, oh shit, it's actually not going to get better. And now here we are. Builders are holding back though on new projects rather than flooding the market because they simply can't make the project economics work. According to a lot of market analysis, many developers are shelving or delaying launches instead of cutting their list prices. So basically they're constricting supply because they can't afford to supply the market at current prices in hopes that that constricted supply might actually push prices up later, unless like, something else in the supply pipeline changes, like development charges get cut, construction costs are already moving down. If developer margins improve, then maybe they'll be incentivized to bring projects to market. As mentioned, some projects have been retooled as rental. So build and industry groups are obviously really lobbying governments to reduce taxes, like expanding the HST rebate beyond first-time buyers to entice more home sales. I'm of the opinion that housing shouldn't be taxed, period. So I don't really absolutely. And I think this is a much better solution to the problem than what Vancouver developers are proposing, which is to completely get rid of the foreign buyer ban, which again, I don't think that that's actually that impactful anyway. And I think they're going to let it expire in 2027. But I just think getting rid of tax on housing seems like a lot more of an appropriate solution. We shouldn't have housing that's taxed like alcohol and cigarettes. Governments have started responding a little bit. Ontario's prorated HST rebate now extends to many buyers and projects, aiming to spur some stalled deals. But it hasn't really made the changes in the market that they wanted to see. So overall, the broader mood is cautious. Obviously, Toronto's real estate market is basically in a wait and see mode, and that hurts people who are spending millions of dollars servicing debt on land. And in the short term, the condo collapse might look like bad news that would solve affordability, right? High prices are the cure for high prices, but with starts at 20-year lows, Toronto risks a bit of a shortage that once the current backlog of completions clears could reignite this housing affordability challenge. There's some recent academic research that suggests that building more luxury condos can actually improve affordability by freeing up cheaper homes. And I'm not of the opinion that trickle-down economics works exceptionally well. I think it was a weird concept and a silly idea, and I think it's been disproven many times over history. But if there's one type of product where trickle-down economics probably does make sense, it's where somebody who is going to buy a top-end product is now vacating a lower-end product. And a new University of Hawaii study in November of 2025, this just came out hot off the press, tracked a 512 unit condo tower in Honolulu and the chain of moves it generated. And the authors found that households moving into the new tower left behind older homes, typically much cheaper than the new units. In other words, new supply created vacancies down market or downstream. So the study concluded that new condominium construction eases supply constraints and expands affordability in a local housing market as older, lower-priced homes become available to other buyers. Even income-restricted units in the tower triggered lower-end vacancies. This is basically a process or effect called filtering, and it means that building new condos can indirectly make existing housing more affordable. And I know, I always see people in the comments here and on TikTok and other places were like, oh, you just have to stop building so many new luxury condos. And it's like, it doesn't matter what you build, just build anything.
My friend Chris Foch did an article about this all the way back in 2018 entitled, "If Toronto Wants Affordable Housing, It Should Build More Luxury Condos." And I feel like a lot of people ripped on him when it first came out, but it turns out to be pretty correct. And he was actually the one who shared this article that tipped me off to it.
We just need to build more because it's a product that doesn't decease once it's consumed, right? Like it's not like a can of soup or a vegetable where you're taking something of a scarce supply that's perishable, and then that means that somebody else can't eat that vegetable. It's a house, and it's a super durable good. It'll last forever, similar to the used car market, but even more durable than the used car or used appliance market. You don't throw a house out when you're done with it, right? So if condo construction were sharply curtailed, like it is in Toronto, this filtering process stops. And with high rates and cost of living pressures, Toronto cannot easily rely on lower demand alone to solve affordability. So people think that this is just, and I think a lot of people are cheering this on, thinking that this is a phenomena that's only going to impact rich housing speculators and blah, blah, blah. But as it trickles through the market, this is something that will become painful for all all consumers of housing. And many experts argue that a steady pipeline of new housing across price ranges is needed to meet long-term demand. A really good example of this is like Austin, right? So Austin built an insane amount of housing, and especially during COVID when they saw that huge flow of people, and rents are now down 7% year over year. Rents are falling in Canada. Why is that the case? We're building an absolute insane amount of purpose-built rental. We have this huge flood of condos coming online. We need more supply if we want to solve the housing crisis. Yeah, I get it. Like a lot of people are going to talk about, sure, shut the demand tap off. The federal government could do a lot on the demand curve. Absolutely, totally agree, right? But let's just set that aside, because it has been solved generally based on the policy environment. And sure, you can say that they're lying about it or whatever, but from what I can see, population isn't growing at the speed that it was before. And the Honolulu findings underscore the point. New homes don't simply satisfy wealthy buyers. They create space for others down the line. Like, just look at Austin. The largest rent drops in the US happen in Austin, where you've literally seen the most supply created on a per capita basis. And the population has been growing massively. One of the fastest growing populations in the US as well, especially during COVID when everyone was going there, fleeing places like New York and California. So Toronto's condo sales, 13 months in a row of declines, okay? The worst condo market we've seen in our lifetimes, hopefully the worst condo market that we will see for the rest of our lifetimes. It's already costing jobs, stalling projects, putting tens of thousands of jobs at risk. We've seen tons of projects canceled. This is having a huge knock-on effect on the economy. Investors are backing off, inventories have surged, and developers are shelving launches. And this pressure on prices will eventually run out of steam in the short run. But what experts are more concerned about is that the slump could tighten long-term supply and hurt affordability. And new research suggests that this is probably true, and that we do need to figure out a way to keep the supply pipeline consistent with what it was. Otherwise, we are running a risk of creating an affordability crisis down the line. Is it immediate? Am I calling for another bull run? Absolutely not. Is this going to have some long-term impacts on housing affordability in Toronto if we can't figure out a way to deliver a comparable amount of supply without reducing the demand? Yes, this is going to be an issue. And policymakers and market participants now face the challenge of balancing today's weak demand with the need for enough homes to keep Toronto affordable in the future. And like when I say demand, it's not just pre-con investor demand or anything like that. Like one of the things that I do a lot of is capital advisory and supporting developers in Canada to raise capital for rental projects. And there's no capital. Like everyone is looking for equity, for private equity, for investors in purpose-built rental projects in the GTA. And I help a lot of Canadian and US investors to get into projects like that, especially US capital, where you're getting a lot of like that left-leaning US capital that is looking for a place to call home with the shift in politics in the US, obviously. And a lot of them are attracted to Canada's market. So we're seeing a lot of, and they can't direct invest. Like American investors typically like to be direct investors, but they legally cannot own Canadian real estate. They could own 5+ units, but they cannot own Canadian residential property. If they want exposure from a residential side of things, they have to find another way to do it. And so we've seen a lot of capital actually coming from south of the border rather than north of the border, because Canada's market is just pretty much toast right now. Like no money's moving. Everyone's stuck in another project. It's so hard to find equity. And so this is the big issue facing Canada's real estate market right now. And as we see that rental pipeline start to shrink outside of Ontario as well, as projects come to completion, they're stabilizing into an environment that wasn't really what they expected. They're probably stabilizing into lower rents and higher vacancy. People are going to stop building rental. And because we've just built record supply, and you get that whipsaw effect, right? This is the way the real estate market functions is, you contemplate a project, you're like, oh, damn, Alberta looks great. Vacancy's 2%. Everyone's moving there. Population's growing at 4 to 11% a year, whatever. I'm going to go build in Alberta. And 50 other people had the same idea. And so now you got 50 people building 1,000 units and nobody's talking to each other. And it takes 2 years for that to come to market. And then you're all stabilizing into this completely different market than you were when you contemplated these projects. This is why real estate has such violent volatility in Canada, because you have that whipsaw effect of like, oh, we flood the market with our supply and now we have to wait for it to get absorbed. And this is what we're seeing even with the purpose-built rental projects in the city of Toronto, like the rents at which they forecasted their projects. So for those of you who know, I'm a broker and chief real estate officer at a company called valery.ca. We're an AI powered real estate brokerage. And one of the things that we're bullish on, because I realize that Canada is heading towards a renter's economy, is helping renters, helping people find rental properties, and then eventually helping renters transition into home buyers. That's something that a goal of our brokers that we hold really near and dear. And what we found is a lot of renters, tenants are applying and they're looking at condos, and then they'll go look at a purpose-built rental, and the condos are way cheaper because you've got these mom and pop landlords who have the agility. They can afford to take a little loss on a couple of unit or on a unit and pay it out of pocket or whatever. They have their own income that they're willing to put in. They're not putting investor capital into the project. It's whatever. You get the purpose-built rentals, they're sitting like 10 to 20% above a comparable unit. And so they're having a really hard time leasing up. A lot of these purpose-built rentals are like big, vacant. Like they're, some of them are 20, 30, 40%, 50% still, because they have to hit those rents in order to get their refi out, because they have to hit their NOI target to get the CMHC refinance on the tail end, which is their term debt, gets them into that 50-year amortization. So, and it's interesting because a lot of the mom and pop landlords are starting to reject your kind of like 650 to 680. Like they really want like the best credit. They're making people prepay rent, et cetera. The rental market's getting super weird in Toronto, especially with the return to office. We're actually seeing quite a bit more demand come up. But the interesting part is like, it's almost like when, if you're a borrower and you're in that 650, let's call it a 650 cutoff. If your credit score is below 650, you pay a little bit of a higher rate. Maybe you have to go to a B lender, or you pay a higher rate on your line of credit or your credit card. And we're starting to see that actually shifting into like the same kind of dichotomy is happening between mom and pop landlords, like let's call it a condo investor, versus a purposeful rental investor, where if you're sub 650, it's going to be harder for you to find a mom and pop landlord. But these purpose-built rentals, many of whom are insuring rents, they can afford vacancies. They have way better systems to keep on track of all this stuff. They register rents on credit, et cetera. You're seeing a lot of that, those 650 and below, getting pushed over to that side of things, and they are paying the premium. It's functionally very similar to people with a lower credit score having to pay a higher interest rate. They now also have to pay a higher rent because of this market dynamic that's forming. That's one of the most interesting things that I've observed as a result of a lot of this. But a lot of these projects are not having an easy time renting out. Urbanation put out a report earlier this year that said that Toronto condo glut forces more landlords to lure tenants with incentives like free rent, says Urbanation. I think it was like two-thirds of purpose-built rental landlords were actually offering like free rent. And we're seeing like 2, 3, 4 months free rent for this stuff. Like the market is really, really messed up. And I think we're probably in like the 4th inning, 5th inning now. So it feels like there's still going to be a little weird. Anyway, let me know what you think in the comments. Thanks a lot for taking the time to watch this video. I really appreciate it. And please hit the subscribe button, leave me a comment, like this video, and I'll see you again as soon as I can.